One of the most common questions I get from sole traders is whether they should restructure. And the tricky part is that most of the advice out there makes it sound like a pretty straightforward decision. But when you actually sit down to make the call, it's actually not that simple. There's a lot of conflicting information, and most of it leaves you in the same spot you started. So, I want to walk you through the framework I actually use with clients when they ask me this question and how I help them figure out whether they should stay where they are or move to something else. I've got to admit, it would be nice if there was a simple rule that helped me answer this question. For example, if you hit 120K profit as a sole trader, it's time to switch to a company. That'd be awesome. But the reality is that structuring decisions aren't really about income thresholds or tax savings in isolation. Two sole traders earning the exact same money can need completely different structures based on what they're actually building. That's why the first question isn't how much are you earning? The first question is what do you want the business to look like? Do you want to build a team? Do you want to eventually step away from the business and have it run without you? Or is it just you and maybe one admin person? And are you happy earning 150K and keeping things simple? Or do you want to shoot for the moon? Because the answer to those questions changes the structure recommendation entirely. And getting it wrong in either direction costs you. Either you're paying for way more complexity that you don't need, or you're in a structure that can't support where you're actually heading. So when I sit down with a client to work through this, I don't start with their income. I start with 6 areas of consideration and I get them to rank which ones matter to them most. Let's go through those 6 areas. The first one is simplicity. How much complexity or simplicity are you willing to manage? A sole trader is as simple as it gets. One ABN, one tax return, minimal admin. A company, on the other hand, with a trust shareholder has multiple entities, multiple returns, and way more moving parts to keep on top of. The second is cost. More complex structures cost more to set up and more to maintain year on year. You're generally paying more in additional tax returns, additional compliance, potentially additional other accounting fees. And if the structure isn't actually doing something for you, that cost's kind of wasted. The third is tax savings. This is the one that most people jump to first, but it only matters relative to the others. A company can give you access to a lower tax rate on profits if you leave the money in the business, and a trust gives you flexibility on how that income is distributed, but those benefits only kick in at certain income levels, and it kind of depends on how you use the money. The fourth is ownership flexibility. This is about who can own the business and how easily that can change. For example, a sole trader is locked to you. You can't give someone part ownership of a sole trader. A company with a trust shareholder gives you options to bring in other shareholders down the track, like team members who want to buy into the business. They allow you to distribute income to other beneficiaries or restructure ownership without having to start from scratch. The fifth is business sale ease. If you ever want to sell your business, the structure you're in at the time of the sale affects how that works and what tax concessions you can access. Some structures make it pretty straightforward to sell, while others make it more expensive to access those same tax concessions at the point when you're trying to exit. And the sixth is asset protection. As a sole trader, there's no legal separation between you and the business. If the business gets sued or takes on debt it can't pay, your personal assets are at risk. A company, on the other hand, creates a level of separation. Now, once we consider all those 6 priorities and once the ranking is clear for a client, the structural options narrow down pretty quickly. For someone whose priorities lean towards simplicity and cost, staying as a sole trader kind of makes sense. For someone whose priorities lean towards tax savings, flexibility, and protection, the options are typically around a company with a trust shareholder or a trading trust. Where people get stuck is in the middle. They know the sole trader structure isn't quite right anymore, but they don't want to go all the way up to the more complex setup. So they end up in a company with themselves as the individual shareholder, which kind of feels like an upgrade, but it limits them in the same ways the sole trader did. If they want to take money out, it still flows directly to them. If they want to distribute to family members or use a bucket company down the track because they're earning more money, they can't without more structural surgery. And restructuring from that halfway point or later down the track when the business is significantly larger is going to cost significantly more than just getting the right structure from the start. I like to think of it like a house. If you know you want a family of 5 in the next couple of years, don't move into a 1-bedroom unit and plan to upgrade again later. And definitely don't move into a 2.5-bedroom unit house thinking that's close enough. Just go straight to the 5-bedroom house, especially when the cost difference in the scheme of a business Isn't that significant? The same logic, though, applies the other way. If it's just you and maybe one other person in the business and you're happy with what the business looks like right now and into the future, that one bedroom unit is probably the right call. You don't need a 5 bedroom house. You'd just be paying to heat rooms you're never going to use. Let's look at an example. I had a client with a psychology clinic with a multi-million dollar turnover, and the business was set up as a company with them individually as a sole shareholder. The problem was this: every dollar of profit that was coming out of the company went straight to them personally. There was no way to distribute income to their spouse, who was on a lower income, or to other family members they genuinely wanted to support. And they couldn't just transfer the shares to a trust because the ATO treats that as a disposing of an asset. Since the business had real value, transferring the shares would actually trigger a capital gain. So we ended up running a cost benefit analysis, basically looking at what it cost to stay the way they were versus what it would cost to make the change. In the end, the restructure cost about $15,000 in fees. On top of that, we had to apply small business capital gains concessions to reduce the tax hit as much as we could. They still ended up paying about $40,000 to $50,000 in tax on the transfer. That's tax they wouldn't have had to have paid if the trust had been the shareholder from day one, which would have cost maybe $2,000 to $3,000 extra at setup. But in their situation, the savings from getting the money out of the business through the trust paid the whole exercise off within 2 years, and they now have a structure working for them moving forward. The other side of that is sole traders who leave the decision too long. I had a client running a clinic with 2 or 3 other clinicians, and every dollar the business made was taxed at that client's personal tax rate, even if the money was sitting in the business bank account. Their previous accountant kept saying they'd worry about it later. When we looked at it, we worked through whether they needed the company with a trust shareholder or whether a trading trust would do the job. They didn't need anyone else to hold the shares in that case. They were either going to sell the whole thing in one day or not at all. So trading trust worked for them. We got the restructure done tax-free, but all those years as a sole trader, they were paying way more tax than they needed to, and that's money they don't get back. So if you're a sole trader and you're not sure whether your current situation still fits where you're heading, the best next step is to get someone to look at your specific situation. Because as you've seen, the answer depends on what you're building, and that's hard to assess from the inside. On that note, if you found this video useful, please like and subscribe, and we'll see you in the next video. Peace.